Hi everyone, welcome to Malitabo Accounting Academy. So on today's lesson, we are going to look at the accounting equation. Specifically, we're going to look at the elements that make up the accounting equation, which are assets, liabilities, and owner's equity. So let's start off with defining assets. So an asset, it is something that is valuable, that is owned by the business, and that can be converted into cash. Assets can be classified into two categories. So we've got non-current assets and current assets. Non-current assets are also known as long-term assets. So what are non-current assets? Non-current assets are assets that are owned by the business for longer than 12 months before they are converted into cash. What are the examples of non-current assets? So we've got land and buildings, also known as property. We have machinery. We have equipment. Equipment could be office equipment such as computers, scanners, and printers. And then we have furniture, we have vehicle, we have long-term investment. Long-term investment could be unit trust, could be shares, could be a money market account. Okay, now let's move to current assets. What are current assets? Are assets that are owned by the business for less than 12 months before they are converted into cash. Yes, so what are the examples of current assets? So the first example is trading stock or trading inventory. Now that is the stock that the business buys for the purpose of selling it. Secondly, we've got bank. That is the money in the bank account or the cash in the bank account of the business. Thirdly, we've got debtors, customers that bought from the business on credit. And then fourthly, we have what we call as petty cash. Now, petty cash, it is the money in the business that is used to pay for small items. And then number 5, we've got a cash float. So what is cash float? Cash float, it is the money in the cash register that is used to provide change to the customer. And then lastly, we've got what we refer to as input VAT. So now we need to remember that the business collects VAT. The business collects value added tax from customers on behalf of SARS. So sometimes it happens that the business would overstate the amount of money that is due to SARS or the amount of money that it pays to SARS. So now the difference between what it actually was supposed to pay and what it paid is that overstated figure, which now is what we refer to as input VAT, meaning SARS owes the business that difference. Okay, now let's go into liabilities. So what are liabilities? A liability is something that you owe. It is a debt, iskoloto, right? Liabilities are also classified into two categories. We've got non-current liabilities and we also have current liabilities, right? What are non-current liabilities? Non-current liabilities are liabilities that are owed for longer than 12 months. So it will take the business more than 12 months to pay up that liability or pay up that debt. So let me give you examples of long-term liabilities or non-current liabilities. So we've got what we refer to as a mortgage loan. A mortgage loan is a bond on a property. So that is when a business buys a property and takes out a loan from the bank and pays the property and then has the property as collateral or has the property as security on the loan. And then the second example of a non-current liability is a long-term loan. So that is any other long-term loan that is not property related. Okay, now I want us to move on to current liabilities. So what are current liabilities? Current liabilities are liabilities that are owed for less than 12 months. So meaning the business will pay up those liabilities in less than 12 months. What are the examples of current liabilities? Okay, so the first one, it is our creditors, also known as suppliers. So when the business buys on credit from the suppliers, and then secondly, it is a short-term loan. So any loan that the business can pay within a period of 12 months. And thirdly, we have a bank overdraft. So a bank overdraft is when the business's bank balance goes into the negative. Meaning, so the business can make an arrangement with the bank to have an overdraft facility. So that practically means that the business will be using money that it does not have, right? And then the last one, oh yes, the last one is output VAT, right? So remember the VAT story where I'm telling you that the business collects value added tax from customers on behalf of SARS. So output VAT, it is when now the business has understated the figure that it is supposed to pay to SARS. Meaning, so the difference between what it paid and what it was supposed to pay, that is what we refer to as the output VAT. And that means we as a business, we owe SARS because we short paid SARS. Okay, now I would like us to get into the third element of that make up the compilation of the accounting equation, which is owner's equity. So what is owner's equity? Owner's equity is equivalent to worth, right? So basically, it is what is the value of the worth of the business, or I can define it as it is what it is left. It is that which is left over for the owners or the shareholders of the business when we have subtracted the liabilities, all the liabilities from the assets. Or I can define it as owner's equity. It is all the capital that is invested by the owners into the business, plus the profit generated since the commencement of business operation, minus the drawings by the owner, minus all the liabilities. So yes, so I'm going to do a second video. I'm going to do another video where I will be explaining to you where does the accounting equation derive from. So the actual equation, the format or the structure even, where does it derive from? So thank you very much for watching. You are more than welcome to comment down below if you've got if you need some clarity on anything that I have been talking about on my lesson or on my video. You are more than welcome to ask me questions. Happy Women's Day. Yes, thank you once more.